Hey everyone, welcome to the first chapter in going through the CSG content for the Audit CA module. So chapter 1 is around the framework, assurance framework. So I guess first of all, what is the purpose of an audit? What is an audit? And what is assurance? So assurance is a function in the financial reporting system where it increases users' confidence in the reliability of information. For example, if you are a shareholder in a company, if you want to invest in a company or you currently have shares in a company, you're making financial decisions to invest your money based on the information given to you in the form of financial statements, which tells you the profitability of companies, what the asset and liability function is, what the cash flow of these businesses. So you have a very strong reliance on this information, and therefore you need this information to be correct. So the assurance process is a way of just checking, including checks and balances to ensure that that information is actually reliable. So external assurance is basically the provision of an independent report, which is your audit report effectively, by an assurance practitioner, which is the accounting/audit firm, on information that is prepared by one party, which would be for example, the listed company on the ASX, or it could be various different types of entities which may require or want an audited. But just in the most common example, it's a listed entity on the ASX or other stock exchange for the benefit of another party. So in this case, it would be the shareholders or the investors in that company. So there is a consistent framework that assurance needs to follow, and that's basically defined by the IAASB, which is the International Auditing and Assurance Standards Board. And so that's the body that oversees the framework. So the framework is a set of rules which enables companies to define what an insurance engagement is, what the objectives is, and it also outlines the two types of insurance engagements. So there's number one, there's reasonable, and number two, there's limited assurance engagements. We'll talk about what each of those mean shortly. So some of the other things that the framework does, so just a reminder, the framework is the set of rules determined by the board, the IASB. The second thing it does is it distinguishes audit assurance engagement from other engagements, for example, consulting engagements. So there is actually a level of reliability and accountability for different levels of engagements, whereas a consulting engagement is purely just you're paying a company for a set of work. If that company gets it wrong, well, there's really no recourse against that company. For an audit, there is. So this is that distinguishment of that factor. Number three, it sets out the preconditions relevant to considering whether to accept or continue. So, for example, one of the things we'll go through later is if you're an auditor, you do have to assess whether or not you have to accept or continue an assurance engagement. Just because the client wants you to be its auditor doesn't mean you can be. So we'll talk about that a little bit about that later. Number four is identifies and discusses the 5 elements of assurance engagements. We'll talk about that later. And then finally, outlines several important principles of professional judgment and professional skepticism, materiality, and engagement risk. So these are all the key concepts of an audit, which we'll talk about in detail later on. So elements of an insurance engagement. So any insurance engagement, so assurance is either assurance or an audit, involves 3 parties. It's a 3-party relationship. So number one is the assurance practitioner. Number 2 is the responsible party. And number 3 is the intended users. So it's going to be, in simple words, it's going to be the audit firm, the company which is producing the financial statements, and the people who use those financial statements. So, for example, PwC might be the accounting firm. The responsible party might be, Google listed on the stock exchange, and intended users would be all of the stakeholders, primarily shareholders. It could be the board of directors. It could be people with contracts. It could be suppliers. All these kinds of things. Employees, for example. Okay, so the 5 elements of the insurance engagement. That's number 1, 3-party relationship. Number 2, an appropriate underlying subject matter. Okay, so there needs to be something that you're auditing. For example, the company's financial performance, could be the company's financial position, could be the company's cash flows. Number 3, suitable criteria. So you need to have something to actually compare it against, and that is the IFRS, the International Financial Reporting Standards. Now, These are the sets of rules that determine how you account for something. So the suitable criteria doesn't necessarily need to be IFRS. This is just the commonly used one from the lens of auditing financial statements. But you could have an insurance engagement which is something completely different to financial. It could be environmental compliance and things like that. This is just an example here. Number 4, sufficient appropriate evidence. So part of the audit approach is you need to actually request enough information, have done enough work, and go through all those enough processes to actually come to an appropriate position, or the auditor has to come to an appropriate position. And finally, number 5, a written assurance report in the form appropriate to a reasonable insurance engagement or a limited insurance engagement. And this is basically the auditor has done all its work. It's got its subject matter, it's got its criteria, it's got its evidence, and now the report is basically the findings. In simple terms, is this company's financial statements or whatever it is you're auditing, is that okay or is it not okay? And we'll talk about the different types of those a little bit later on. So the next thing we're going to be talking about is attestation and direct engagement. So attestation engagement is basically where a party other than the assurance practitioner measures, evaluates the underlying subject matter against the criteria, and often presents this in a report statement. For example, audits of financial statements, or it could be a review of historical financial information. A direct engagement is assurance practitioner is also the measure/evaluator of the underlying subject matter, and they apply assurance skills and techniques to obtain sufficient about the subject matter. So assurance practitioner reports directly on the underlying subject matter and provides users with an assurance report, not the responsible party management. Okay, let's talk about this really important point now, which is levels of assurance. So I mentioned before, within the auditing framework, there's not just one audit and that's it. There's different levels, and each of those different levels have a different level of responsibility of the auditor, and people can actually hold the person accountable to that level of assurance. And of course, that's going to correlate with fees and etc. Because the higher the level of assurance, the more time, the more effort, and the more risk the firm is going to carry, and therefore they're going to charge a lot more money. So let me just zoom out on this one. So there's two types of assurance engagements. There's reasonable assurance and there's limited assurance engagements. So the higher the quality of assurance, the greater the quality and quantity of evidence gathered, and consequently the more confidence users can have. So if you're in a listed entity where billions of dollars are being exchanged, you're going to need the highest level of engagement. So the auditor's going to have to provide the highest level of assurance. It's going to require a lot of work. It's going to cost a lot of money, but at the end of the day, it's important so that our financial system, the checks and balances, work effectively. You can see in this visual chart from the CSG 3 different engagements and how they correlate with the 2 types of insurance engagements. So number 1 is just agreed upon procedures. So it's called related services. For example, agreed upon procedures. So agreed upon procedures was basically, you might have a consulting firm, might even be an audit firm like PwC, KPMG, EY, etc. But they're just saying, look, we're only going to do this work. We're going to do this, this, this. We're agreeing on the scope, and this is what we're going to do. However, this doesn't provide any assurance. So if we go through this process and later on we find out, like in the case of Wirecard recently, that their cash balances were actually completely wrong, no one can sue the accounting firm because there's no assurance level provided. It's just agreed upon procedures. And the more important point here is that the auditor doesn't actually express any opinion on it. It doesn't say, in our opinion, we think there is no fraud happening. Okay, what they say is nothing at all, because it's not an assurance engagement. Next, we're moving on to the higher level of assurance. So this is no assurance, and then this is a limited level of assurance. So for example, a review. So a company might go to Ernst & Young and say, look, we've got all these historical financial information. We want you to just go through it and review it because our board of directors thinks that there might have been some accounting discrepancies. And the accounting firm's going to say, okay, we can do that, and we can express an opinion, but it's going to be limited assurance. And that opinion by the auditor or by the accounting firm is going to be a negative conclusion. And what that basically means is it's not saying, in our opinion, we think this. It's saying nothing has come to our attention. So if they did find something in that limited review, they would flag it. What they're saying is, in our limited review, we haven't identified anything. That doesn't mean that there's no issues that exist in the company, because we're only looking at, this small percent of the company. If there's 5% or 10% of the company, we don't know about the rest of the 90%. All they say is, we don't know, we didn't see anything in that 5%. And then the next level up is the audit, is an audit, which is an example of reasonable assurance engagement. And this is basically where you've done a lot of work and the auditor actually expresses a positive opinion. And what that means is, in our opinion, and they may say, in our opinion, that we do not believe there's any instances of fraud in the company or something like that. They cannot say that there is no instances of fraud, but we can say, in our opinion. So you can see the difference between negative and positive opinion. Negative is very limited. It's leaving out any commentary, whereas a positive opinion is saying, we believe this. Okay, so just quickly going over some of the assurance skills and techniques. So number one, whenever you're going through an assurance engagement, you should be applying a level of professional skepticism, which means if something tells you something, don't just automatically believe it. Actually apply some questioning thinking. If someone says our cash balance is $1 million, say, okay, can you please provide a bank statement? We look at the bank statement, we've independently checked it. Okay, now we can believe what they're saying rather than just relying on them. Number two, planning and performing in performance engagement, including obtaining and evaluating evidence. So you need to actually plan it, you need to perform it, and you need to obtain evidence. Understanding from IT systems and the role and limitations of internal control. So control is a big concept, which we'll talk about later. Linking the consideration of materiality and engagement risk to the nature, timing, extent of procedures. So it's really understanding the company before you're going in. It's going, okay, is this a high-risk company? And which areas are the highest risks? And then going in and actually testing those more than others. Applying procedures as appropriate to the engagement. So fairly similar to above, it's really tailoring your approach to the company because we have limited time and resources. It's physically impossible for an auditor to go through and check every single financial statement of a company. What they need to do is looking at the right areas, identifying the risk areas and targeting those. So being as efficient as possible to try and identify that risk with using the minimal amount of resources. That's basically auditing. And then, of course, systemic documentation practices and report writing skills. So what they say in audit is if it's not written down, if it's not documented, then it's like you've never done it. Anything that is done in an audit needs to be documented and written down effectively as proof that you've actually done the process. Okay, now another type of engagement is due diligence engagements, and this is probably more on the form in the category of related services. So it's basically an engagement where an accounting firm is engaged to to investigate financial results or operational activities of an organization. Commonly, it's a target for acquisition, and you'll do due diligence on a company that you're looking to buy. Consulting or advisory engagements, again, within this category of here, related services, is just basically a one-off task. Typically relate to the design and development of new methods, approach, strategies, and may include the implementation of new systems, etc. Okay, so let's talk about the framework of who actually oversees the international auditing standard setting, because these are global. This is a global framework. So similar to IFRS, where that's overseen by a board, and then you've got IFRS, and then you've got local kind of adjustments to standards. In the audit module, you're not really often tested on these, but it's good to kind of understand for your own personal knowledge. There's three key entities which oversee, the audit framework. So first of all, IFAC, which is the International Federation of Accountants. There's IASB, which oversee the setting of standards, and IESBA, which is an independent standards setting board that serves public interest by developing and issuing high quality ethical standards. Okay, so it's not super important to understand this, so let's just move on. There's also this government agency as well, which is the AUASB, the Auditing and Assurance Standards Board, which is a statutory agency, so it's actually owned by the Australian government, and that's also there to develop, issue, maintain auditing and assurance standards. And those standards are set by the Accounting Professional Ethics Standards Boards. And these standards largely just follow the international equivalents issued by IASB and ESBA. So it's very similar to FIN, if you've done FIN, where you've got your international standards, IFRS, and then you've got your local standards, so your Australian accounting standards, but they're pretty much the same thing. The Australian accounting standards will just take the IFRS, give it its own naming convention, and there might be a few local nuances, like just to adapt it to the Australian economy. For example, you might have GST referred to somewhere in there, or something like that. But generally, it's the same thing. It's the same thing with audit as well. So you've got your local adaptations, but they're pretty much the same thing as the international accounting standards. Let's talk about legislative requirements for audits. So under the Corporations Act 2001, which is an Australian act, it requires entities registered under the act to prepare an annual financial report and have it audited. So these certain entities that are required to do this are disclosing entities, public entities, large proprietary companies, and registered schemes. So you probably remember this from university, FIN, and a few different other topics. So these are basically general reporting entities who have key stakeholders. So for example, public entities is going to be a listed stock market company. Large proprietary companies is basically, it's a private company, but it's a company which is greater than certain thresholds based on revenue, assets, and number of employees. So any private company, for example, Priceline in Australia, even though it's not listed on the stock exchange, you still need to submit this annual financial reports to ASIC, and they need to be audited. Okay, so disclosing entities need to prepare half-yearly financial reports and have these audited and reviews. Companies limited by guarantee with annual or consolidated revenue less than $1 million may elect to have their annual financial report reviewed rather than audited. So there are a few loopholes you can elect so you don't actually have it audited. So to help reduce costs for the preparers, so you can have it reviewed rather than audited. In addition, the auditor must comply with the Act's requirements when conducting an audit review, including forming an opinion on whether the financial report is in accordance with the accounting standards and gives a true and fair view, conducting the engagement in accordance with auditing standards, retaining work papers for 7 years, providing the director of the clients with an independence declaration, reporting to the members of the client as to whether the financial report is in accordance with the Corporations Act, reporting to ASIC any suspected contraventions of the Corporations Act during the conduct of an audit or review. Okay. What the auditor's objectives and responsibilities in conducting an audit are. So auditors' overall objectives. So the purpose of an audit is to enhance the degree of confidence of intended users in FinStats through an auditor's opinion on whether the FinStats are prepared in all material aspects in accordance with an applicable financial reporting framework. Okay. Requirements in conducting audit. Number 1, ethics. The auditor must comply with ethical standards. Number 2, professional skepticism. We talked about this earlier. It's basically, in a nutshell, even if you're given, it's an attitude of being questioning. Even if you're being given information, you need to think skeptically and say, is this information correct? We need to confirm this independently. So the textbook describes this as an attitude that includes having a questioning mind, being alert to conditions that may indicate possible misstatement due to error or fraud, and critically assessing audit evidence. So don't just believe everything just because it's being provided to you, and look for conditions that may indicate possible fraud. Okay. professional judgment. This is number 3. So you need to make decisions and judgments with relevant knowledge and experience. So this is important because there's a lot of elements in an audit which are qualitative. So there's no set rules saying, the materiality on an audit should be this, or the risk for this entity should be this, or is this okay or this isn't okay. So probably more so than fin, tax, math, and so forth, that there is a lot of qualitative judgment to be made in this. And what one person might think is okay might not be okay in the eyes of another person. So it is a bit of a wishy-washy subject. So there's a few concepts that you need to understand. So first of all, materiality and audit risk. So materiality is a concept you'll hear over and over and over again in this audit chapter. So you'll hear, we've even got a chapter over here on materiality. So basically in the concept of audit, as I mentioned before, it's not about making sure that a particular entity has no fraud and has every single transaction perfect. That's not the point. The point is to, with the available resources, check the key risk areas in a company in the most efficient way using the resources and time you have to identify risk with the greatest chance. And when we say risk, we're talking about fraud, we're talking about misstatement, etc. So when we're talking about a misstatement, like, they might have done a journal wrong, or they might have overstated or understated an asset. There could be so many different things. There's this concept of materiality, right? Because if you've got something wrong by $1, obviously it's not a big deal. But if you've got something wrong by $1 million, that's probably going to be more of a big deal. But what if it's a company that deals with billions and billions and billions of dollars, even trillions of dollars? $1 million might only be 0.001% of the company. And in that case, $1 million variance might be really small. It really depends on the company. So materiality is a concept which helps us identify how big does the dollar value have to be for it to be an issue. And we use that threshold when we're going through the audit, and everything below that threshold, we say, well, it's probably not a big deal because it's small relative to the overall scheme of things. So that's a short lesson on materiality. We'll obviously talk about that later when we get to the materiality topic. Okay, so you need to actually have judgment on that because it is a qualitative. Same with audit risk. Understanding risk, and one person's judgment of risk might be different to another person's judgment of risk. Okay. Sorry, I went off a bit on a tangent there. The next professional judgment that you need to have in an audit is understanding the nature, timing, and extent of audit procedures to gather audit evidence, evaluating whether sufficient appropriate audit evidence has been obtained, evaluating management judgments in applying the entity's financial reporting framework, drawing conclusions based on evidence obtained, and forming an audit opinion. So this is the effective judgment process for an auditor, which helps us have a process for what is a relatively qualitative process. So number 1 is identify and define the issue. Number 2 is gather the facts and information and identify the relevant literature. Number 3 is perform the analysis and identify alternatives. Number 4 is make the decision. Number 5 is review and complete the documentation and rationale for the conclusion. So number 4, sufficient appropriate evidence and audit risk. So just to recap, because there's a lot of different lists that we're going off concurrently, we're still talking about requirements in conducting an audit. As a recap, number 1 was ethics, number 2 was professional skepticism, number 3 was professional judgment, number 4 is sufficient appropriate evidence and appropriate audit evidence and audit risk. So an auditor must obtain sufficient appropriate evidence to reduce audit risk to an acceptably low level. See, notice that wording, acceptably low level. So we know, and the accounting standard, the audit standards know that you're never going to get rid of audit risk completely. It's just getting it to an acceptably low level to enable them to draw a reasonable conclusion on which to base the audit opinion. So audit evidence is commonly sourced from clients' accounting records, so ledgers, journals, and invoices, discussions with the client and external sources, banks, share registries, and so forth. And then you have to evaluate the sufficiency of the evidence. So just because you have the evidence doesn't mean it's good enough. You need to actually look at it and say, is this evidence what we need? Does it tell the story? And is it enough information for us to actually identify the risk of material misstatement and fraud and actually come to a conclusion. Okay, so this is actually a pretty important one. This is the different types of audit procedures by category. And this is important because when you get your exam questions, most of the audit style questions will be along the lines of come up with an audit procedure to help identify a certain risk. That's the vast majority of audit questions you will get. So it's important to know these types of audit procedures and then come up with some own examples of your own. So inspection, I'll just go through one by one and then give you an example of each. So inspection. An example is an auditor inspecting accounting records, paper and electronic, or assets. Observation. The auditor watches a procedure being performed by others, for example, an inventory count. Number 3, external confirmation. Example, the auditor obtains written confirmation from the entity's solicitor, or it might be a bank confirmation to check that the bank account actually exists. So in the recent Wirecard fraud scandal, which is a German payment company, basically the issue was they said that they had several $1 billion in cash overseas in Singapore and the Philippines, and EY, their auditor, didn't actually do any bank confirmations. They looked at the statement and said, yep, that's fine. But the bank statements were actually fraudulent. Someone had made them up and then been making up transactions all this time, so the revenue was overstated. If they had just done a simple confirmation, if they just written to the bank and independently checked that that bank balance was there, they wouldn't have been into this mess, or they would have identified it a lot earlier. So that's actually the auditor's fault on this one. And they're in a lot of trouble for that. Okay, next is recalculations. So the auditor checks the calculation. So for example, you might have a calculation of how they calculate revenue. Okay, and then the auditor requests the work paper and they go in and they say, okay, let's have a look. So they've gone customer times this. Yep, that checks out. Or they might identify that there's an error in their calculation and that if they had done the calculation correctly, the revenue would be X amount. And that would result in an adjustment. Well, first of all, they'd check if that adjustment was material. If it was material, they would request it adjusted. If it's not material, they can probably pass on it. And if the entity that they're auditing doesn't make the adjustment, then they can issue a bad opinion. We'll talk about the different types of opinions later on, but just in simple language, they'll issue a bad opinion and say, look, we recommended this. We probably think there's errors. They haven't accepted it. Therefore, we can't issue a supportive opinion, basically. That's not the technical language. We'll get onto that later. It's just talking simple for now. Okay, reperformance. So the auditor executes controls originally performed as part of the internal control of the audit being audited. So a big part of audits are controls. We'll talk about that later. So we can actually do substantive analytical procedures or test controls. So analytical procedures might be doing a calculation, as I mentioned before, or it might be testing the controls, because if the controls work, you know that the company has good processes. You know there's less chance of fraud. So, for example, if the company has really good AP processes, we know there's a reduced chance of there being people being sent fake invoices. Therefore, revenue is less likely to be wrong. We might do less testing in that area. So, reperformance is one of the tests you can do of controls, right? Because if your accounting team is saying, yeah, we've got really good AP processes. So the auditor might say, okay, let me test that myself. I'm going to put through an invoice. And let's see what happens. I'm going to put for a fake invoice. Now, if that fake invoice goes through to get paid, well, there is a control issue. And we probably can't rely on the statement from the company that their controls are good, which is where the professional skepticism comes in. Next is analytical procedures. So the auditor evaluates financial information by analyzing plausible relationships among financial and non-financial data. And then finally, inquiry. The auditor makes inquiry of management. So you can get some information by just talking to people, Okay, audit risk. So as I mentioned before, one of the key goals of an audit is to reduce the risk or the audit risk of a company to an acceptably low level. So the The audit risk is the risk that the auditor expresses an unmodified, i.e. a clean opinion, when the financial statements are materially misstated. In other words, the accountant says, yep, this is all good, but in reality, in the 80% of the business they haven't checked, there's a whole lot of fraud, which means that the financial statements are misstated and that investors or whoever the stakeholder is relying on information that is wrong. Therefore, the balances and checks of the financial system aren't working. This is audit risk, and it's what we want to do is get rid of it. Sorry, we want to keep it to an acceptably low level, not eliminate it. See, it says here it's not possible to eliminate audit risk entirely, but we get it to an acceptably low level. Okay, so these are the types of audit risk. This is actually the formula for calculating audit risk, but it's just a way of illustrating what it's comprised of. So number one is inherent risk. So that's basically the susceptibility to material misstatement before considering related controls. So before you take into account controls, is there a risk that the financial statements are just materially wrong? And number two is risk that a material misstatement is not prevented or detected and corrected by internal control. So it's basically control risk and non-control risk. And then detection risk is the risk that the audit. Okay, so number one is that there's actually a risk that there's actually a misstatement existing in the financial statements. That's those two things in the brackets. It's either control or non-control based. And then there's the risk that the audit will not actually detect these misstatements. So there might be a risk in here, but it'll be corrected by the audit. The risk is, what if there's one in there that's not detected by the audit? And that results in audit risk. So you don't need to know this formula. This is just to help visualize what it is, effectively. Okay, so relationship between risk and audit evidence. So as the risk of material misstatement increases, auditors need to obtain more and better quality audit evidence. So if you identify at the beginning of an audit planning or throughout the process of the audit, you identify some issues with the information or the risk, the auditor needs to obtain more information. If it's a low-risk client, they can do it relatively smoothly. Say, yep, that's good. The controls are good. I haven't found any issues. We can probably sign off on this. But if you start going through it and saying, oh, there's an issue there, there's an issue there, you're going to have to do more testing. You're going to have to ask for more information. You can't just say, yep, there's a small issue here and just call it that. You need to look further. Okay, documentation. So I mentioned before that documentation is a really important process in audit, because if there's no documentation, it's like the process never took place. There needs to be proof that we've tested this. So if anyone comes back later and says, oh, but you didn't check the cash balance, and the auditor says, oh yeah, we did, there's actually proof. You can say, we looked at this, and this. It's all time-stamped. So the entity can't say, I tested it when they didn't, and vice versa. You know exactly what was tested. So this is typically done through the style of a memo. So it's just basically a story. It was like, we tested this, the results were this, the implication is this, it's material, not material, and so forth. So you're not going to be tested on this. As I mentioned before, most of the questions in an exam will be around coming up with your own solutions for doing an audit test. And that's actually going to require some creativity on your part. So we'll go through that later on. So the process of an audit. Number one is pre-engagement. Number two is planning, so initial risk assessment. And that's going to kind of help you develop how you're going to approach it, where the risk areas are, how do we approach those risks, and so forth, and how much information we're going to request. Next is response to risk, which is basically what I just said just then, is how we're going to do it, how are we going to mitigate those risks that we identified. And then finally is finalizing the audit. Okay, you might have heard of this CAAT or CATS versus data analytics. It's basically just looking at, auditors are using software, proprietary technology these days to help them go through much more detailed information than they were able to do previously. So this is CATS or data analytics. It covers everything off from using audit firms' proprietary software to using off-the-shelf software, e.g. Excel, to conduct a test that would have previously been done manually. So, for example, looking through invoice numbers to ensure no duplicate or missing invoice numbers in Excel, using the sort function by ascending order. So a lot of audit processes, once you're actually doing the work, is coming up with clever ways to be as efficient as possible to try and identify issues. So it's really thinking outside of the box and saying, okay, let's look for duplicate invoices. Let's look for invoices above this amount, because someone could have accidentally typed 2 zeros, and then you've got this really large amount, and you can easily find that just by filtering it, by sorting it, by doing searches and things like that. So that's when doing these CATs and data analytics actually comes into play. And that's just part of this entire concept of technology transforming the audit process. You're not really going to get tested on this in the exam. It's more just out of personal interest about how it's really helping the balances and checks of the financial system. Because previously, if you think back in the the 1980s, if they did audits by hand, just checking records and things like that, the chance of them picking up things like a duplicate invoice or fraudulent invoice or an erroneous invoice is much lower than if we're going to go through it using technology. So ultimately, this is much better off for the financial system. So that's everything for Chapter 1. I hope that's a good overview of what auditing is, what the framework for audit is, what the different types of audit is, what the key skills of the audit is, and yeah. After that, in each of the chapters, we're going to go in a bit of a deep dive into each of the different areas and go into a lot more detail so you understand them and go into the technical detail and what to expect in your exam.